Welcome to the Wall Street Crossover Show, brought to you by Tip TV in conjunction with our sponsors Admiral Markets. As we know, Darren Sinden's away on vacation this week, so it gives me great pleasure to reintroduce Mr. Craig Drake. Craig, how are you? Obviously, Monday morning, it's all about Greece, amongst other things. We go through a number of slides, including the European movers. Everything's on the loser board.
Yeah, I mean, like markets across the board are down, and everything's slumping. We don't really have any earnings out today, so everything's about Greece. We've already seen kind of E-mini futures are down, Dow futures are down, Nasdaq futures are down. Everything before the US opening is down, and we're probably going to see a bit of a heavy selling session once they open. Some Italian financials haven't even opened this morning. You've got kind of sell orders piling up that just aren't being serviced. We're just seeing a bloodbath out there, and there's no liquidity out there. There was no liquidity last week, and there certainly isn't any this week.
China closed down 7%, wasn't it?
Yeah, absolutely.
Which, again, on a different day, would probably be making the headlines.
Yeah, they're down 20% in the last
10 days.
In 10 days. So not a great market out there at the moment.
Sounds like a bubble to me. Okay, well, we've got a number of slides. Let's go through these. First one, data released over the European session.
Yeah.
What caught your attention, if anything?
Yeah, well,
on a non-data day.
I mean, we had US mortgage approvals that came out. They were weaker than expected. We've kind of seen this decline. It's been a kind of a long-run trend in UK mortgage approvals. The Bank of England brought in macroprudential measures last year to try and take some of the froth out of the housing market, to try and put in a few more rigorous checks on affordability levels and that kind of thing. So although we've had slightly weaker mortgage approvals, that's more of a symptom of those macroprudential measures as opposed to a bellwether of the UK economy at the moment.
Okay.
But then if we look at the all these European sentiment numbers, we've had services sentiment, consumer sentiment, they're kind of slightly academic today. Obviously all these surveys are taken earlier in the month, and so they've largely been glossed over. We've still seen some weakening of economic sentiment in the Eurozone. Again, this is quite dated data now, but it has stood up stronger than expected. With the main source of weakness has been in the retail sector, and when we look at employment plans, there's been a significant deterioration in hiring plans from the retail sector. But construction and services have held up, and we've seen that through French data, through Italian data. We have seen that resilience that's kind of built up when we've seen PMIs, and that's largely through to credit filtering down into businesses as a result of QE. But whenever
it's quite extraordinary in terms of the US retail sales numbers. I was expecting after the drop in oil price, the fact that retail sales will improve, and they didn't. It was as if people had a memory of sort of leaner times.
Yeah, exactly. People have gone through quite a protracted recession.
Yeah.
I mean, the hope is, and if you're Keynesian, you're always going to want to see that kind of that velocity, and you're going to want to see people going out spending, and governments love people spending. And governments do not like savers. Savers are a bad thing if you're a government, but people aren't. People do not behave that way. People have gone through rough times. They want to stick at some safety net they want to have a safety net. They want to have some cash in the bank. And I suspect that's what we're seeing at the moment.